A quick lesson on average versus actual rates of return. Knowing the difference between average rates of return versus actual rates of return is extremely important when trying to understand how the stock market really works. The most common retirement plans in this country today are IRAs and 401ks. The underlying investments for those plans are mutual funds, which purchase stocks from the stock market. To demonstrate the difference between the two rates of return, we are using exaggerated numbers to illustrate our point. For example, if you have $100,000 in a retirement account, and in the first year you earned a 100% rate of return, you would have $200,000 at the end of that first year, and your average rate of return would be 100%. If during the second year you incurred a loss of 50%, your account value would drop back to the original $100,000, and the average rate of return would now be 25%. That average rate of return would be computed by subtracting the 50% loss from the positive 100% gain and dividing the resulting number of a positive 50% by 2, the number of years you invested, thus equaling the 25% average rate of return. But as you can see in our example, even though the average rate of return was 25%, the actual rate of return, or effective yield, is 0, because during the 2-year period you experienced no real net gain. You started with $100,000 and you ended with $100,000. So the next time someone tells you their mutual fund has averaged 8% per year or more, ask them to tell you what the effective yield or actual rate of return was. More than likely, they won't even know what the difference between the two is. If you would like to understand more about how this information applies to you and your retirement, please contact the person that sent you this email, or click on the link in the email titled A 5-Minute Lesson on Average versus Actual Rates of Return, and we will gladly share additional valuable information with you.